Our guest today is Mr. Chirag Mehta, CIO, Quantum Mutual Fund. He's also the fund manager in charge of Quantum Gold Savings Fund, which he has been managing since April 2011. And if you want a fundamentals-oriented view on the prospects of gold, he's the man to go to. So, good morning, Chirag. Tomorrow is Akshay
Good morning,
Tritiya,
Sanjay.
and a lot of people will want to add gold to their portfolios tomorrow. So we want to tell you to tell our viewers what the prospects are for gold. In your view, what are the positive drivers for gold today, which could move prices up?
Sure, Sanjay. Wish all the viewers and your team as well a very happy Akshay Tritiya. Akshay Tritiya is one of the biggest gold buying days in India. It's second largest gold buying day in India. A lot of gold gets bought because of the auspiciousness attached to it. From a prospect perspective, what we are seeing is after a big rally in gold that we saw in 2020 because of the COVID crisis, gold has been in a consolidation mode since then. We have seen prices move in a range-bound movement, and there are reasons why we have seen that. There are contrasting forces on both the sides that is leading to that behavior in gold. One is at one end, because of so much money being pumped in by central banks across the world, there has been a monetary inflation, which has resulted into price inflation. Secondly, there is also supply side constraints, which is leading because of war in Russia, Ukraine, and plus because of the supply chains getting disrupted because of COVID, we are seeing a lot of supply side inflation also coming in. So there has been monetary inflation, plus there has been supply side crunch, leading to the inflation that we are seeing today. So in the US, inflation is about 7%. And in many places across the world, in Europe or in any other developed market, or even in emerging economies like India, inflation has been inching higher. So that has been one fundamentally big support of gold, plus the geopolitical issues that we are seeing in Russia, Ukraine, and there are similar geopolitical hotspots across the globe, be it China, Taiwan, or be it neighboring countries to India, or be it Middle East. There are many geopolitical hotspots. And because of the conflict that we have seen that has escalated to a significant level in Russia, Ukraine, there is and will be a geopolitical premium built in the gold prices. So that's on the positive side. One is inflation running higher, interest rates remaining low. So real interest rates, which has been a big driver for gold, is negative in most parts of the globe. And therefore, that's been a big support for gold. Second, on the negative side, what we're seeing is central banks inching up their ante. They are saying that we will be more aggressive with rate hikes. We will suck out liquidity, which has been usually negative for gold. And US has been at the forefront, and given US has been at the forefront of this aggressiveness, we are seeing that dollar being supported to a significant level. So if you'll see, dollar is trading at multi-year highs currently, and which is also leading to an impact on gold. So these contra forces of central banks acting on one side, plus inflation and geopolitical on the other side, is having a range-bound movement on gold, and we don't see that changing. In the short term, gold prices will remain range-bound in a range with an upward bias, of course, because of the risk that we are seeing. And for a short term, like 3 to 6 months, we should expect that behavior from gold to continue. But beyond that, you will see some positiveness because there is a increased risk of a policy error happening. Be it central banks aggressively tighten, which may lead to impact on growth, and therefore they're taking a U-turn in their policy. And whenever there is a U-turn that we see, because from their current tightening stance to a loosening stance, that is when you will see prospects for gold brighten up and gold prices doing well.
So in these circumstances, Chirag, what is the advice to investors? What should they do? Should they buy? Should they not buy? What would you suggest?
Yeah, so I know many will be looking to buy gold on auspiciousness and thinking about whether they should make a token purchase or they should buy some bulk. Usually, whenever historically we have seen the phases of consolidation have been good to add gold to your portfolio. Because usually how gold moves is there are phases of consolidation and suddenly there will be a trigger and gold prices gets repriced. And that is how we have seen gold move. So this phase of consolidation we are seeing since August, September 2020 till now, I think it's been an excellent place or area where you should add gold on any declines in your portfolio. So if you're looking to add gold to Akshaya Tritiya, then I think you can add slightly more than a token purchase, given that it's still in a consolidation phase. Had gold prices been at high and moving higher, I would advise that you could have dealt with a token purchase and not by bulk. But given it's still in consolidation, I think, and prospects looking brighter beyond 1.5 year, 2 years kind of time frame, I think this could be a good level to add gold to your portfolio. So if you're not that adequately exposed to gold to about 10 to 15% of your portfolio, then you should try and bridge that gap by adding gold as Akshaya Tritiya.
And why use an ETF or a gold fund to invest in gold?
So ETFs are very, very efficient from a price perspective. You buy gold at a very low denomination, 0.01 grams of gold at a very wholesale market prices. So that's the efficiency that ETFs bring to the table. There are no significant markups or making charges involved, which you usually pay when you buy physical gold. So that's the biggest advantage. Plus, there are no risk of purity. There is no risk of storage. There is no hassle of safekeeping of gold. Everything is done by the fund house. So that really is very convenient, very efficient form of purchasing gold. And that is why you should look at a gold ETF. Plus, it is very, very liquid. It's been trading since 2008. Any quantity, any point in time you want to buy and sell, you can buy and sell easily. And there are no discounts usually because gold ETFs are fungible. Given they are backed by gold, they are very, very fungible. Unfungible instruments that we have seen trading in gold markets have been usually trading at a discount to the gold prices, whereas gold ETFs largely trade in line with gold markets. And therefore, they make it for an efficient purchase and allow you to rebalance your portfolio whenever you need, because getting in and getting out of a gold ETF has been very, very easy because of its liquidity and fungibility that it offers. So I think gold ETFs are better suited vehicles for investing in gold.
Now, when we buy other ETFs, we look at the tracking error, we look at the cost of the ETF. Should investors consider these figures also when selecting a gold ETF?
Yes, tracking error is one of the yardsticks to measure the performance of gold ETF rather than the returns. You should look at tracking error, how closely the fund managers tracking that gold, tracking underlying gold prices. And also, there is small difference between expense ratios. Expense ratios also do matter because that may add to tracking error. So net, if you're evaluating a tracking error, it incorporates everything. So tracking error is one place that you should see before investing in any gold ETF.
And besides ETF, sovereign gold bond is another product that investors normally go for. So whom would you suggest a sovereign gold bond to, and who should go for an ETF?
So fundamentally, if you see why one invests in gold is because gold is no one else's liabilities. The thing that we are seeing in around Russia, Ukraine, etc., makes you realize why do you buy gold. So gold ETFs are vehicles which are completely backed by gold. Each and every unit is having a gold backing to it. Sovereign gold bonds at the other end are, from a return perspective, very efficient because they give you interest over and above the gold price appreciation. But at the same time, they're not backed by gold. They're backed by a government guarantee. So it depends on your belief, what you believe in you should be investing into. Plus, if your horizon is less than the maturity in which the bond that you're investing into, then it may have an issue for you because the liquidity in gold bonds is not that high, and because of which they usually trade at a discount. So if you buy today in an issuance and if you want to exit before the maturity period, or you have to rebalance your portfolio and therefore sell some portion of gold if it depreciates, then probably it may have an issue from a liquidity perspective. So if your horizon is shorter, or if you think you have to rebalance your portfolio, then gold ETFs are more suited. And if you think that you're okay with a government guaranteed bond, and if you think that your horizon is larger than the maturity of the bond, then you could go for a bond. So it depends on your personal preferences and what you want to invest for.
Thank you so much, Chirag. Thank you,
Sanjay. It's been a pleasure. Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.